Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On a day when we're asking the question, is the worst of the Trump sell-off behind us? Today I'll be talking to Junbei Liu of 10Cap Capital and of course Paul Rickard of the Switzer Report. And for something different, I'm going to talk to David Bates. Now David is an expert on industrial relations and HR. And we're going to look at Labor's suggestion that they're going to ban non-competing clauses as a part of their election pitch to voters. And we'll see what that really means, how that will affect employees and how it will affect employers who might be worried that if an employee leaves the workplace, they might take intellectual property as well as the client list and start stealing clients. So that's the show for tonight. So without any further ado, let's cross to Junbei Liu of 10Cap Capital. Thanks for joining us, Junbei Liu.
Thank you for having me, Peter.
Okay, let's just start from where most people are wondering is the worst of the Trump sell-off of stocks behind us, the worst?
I do think so. I think, we have passed the worst peak of uncertainty, if you like, about what could happen. Right now, of course, we still don't know what sort of trade deal will be done or how bad it can get between China and US. But right now, the market stopped reacting to the number because whether it's 100% or 120% or 140%, it's ultimately there will be a deal done somewhere there.
Yeah. And do you think the fact that he's now showing that he's flexible and he will do U-turns, the market is accepting that as being a good sign for what might happen in the future?
Look, absolutely. So ultimately, he seems to want to do a deal for America, a good deal for America. Of course, at the same time, raise some money, some income for America as well. But so far, what he has demonstrated is pushing out some of the tariff for some countries or most countries for 3 months, and then you've got China. Of course, still looks like it's getting worse, but the feel is that something will happen. And also the way he talk about certain tech sectors being excluded, but of course there's new to come. It's just a very typical Trump administration. They don't want you to taking them for granted, thinking they're going to do this way or that, but ultimately they want to do a deal and to get the best deal for America. So we certainly think he has shown that he is flexible.
Yeah. Historically, you've been a buy the dip kind of person. But in the past, the political leaders you had to deal with kind of were inside the box. Now, Donald Trump is outside the box. Does it add a little bit of trepidation to your courageous buying when the market's down?
Yeah, look, I think it just requires a bit more thinking about what has really changed and what does that mean for the company fundamental. What you do in this sort of environment, you call the companies. You speak to the company about what's being impacted, how they deal with it, and also work out the company who hasn't been impacted. Many of those businesses, share price down significantly, and yet there's no earnings impact for these companies. So, that's when we actually now see a lot of buying opportunity. In fact, we've been buying the last couple of weeks to see just straight into these businesses because in a way they're kind of easier, so I don't have to make a call about what the tariff look like. Now the next phase of course is the tariff impacted companies, but these might take a little bit longer, and then of course the secondary impact, then people talk about, oh, is the US consumer slowing down and the like. Then that comes down to how much share price has come down. Many of them are down so significantly, more than compensate for the slowdown that is predicted to come.
Okay, so today for the Switzer Report, I just made the argument that so many great companies are at much lower prices, and I'm taking the punt that by the end of this year, most of the Trump controversies around tariffs will be settled to some shape or form, and the market will like the confidence effect and start going up. And so these are the names I like, and I'll be interested to see what you think. First one I like is CSL, but there are question marks about whether Donald Trump might do something with pharmaceuticals. What's your view on CSL at this point in time?
Look, CSL is pretty good. I think Donald Trump is going to do something on the pharmaceutical, but net impact isn't that large, relative to some other businesses. I think the company share price is very cheap relative to what it used to trade at, and it's reasonably defensive. Aside from tariff impact, it doesn't, the earning will grow double digit regardless of where US economy will be. So, I do think it is a buy here.
Yeah. The next one is Zero, which I like a lot, and I think Macquarie does as well. And all the analysts like it. What's your current view on Zero?
Oh, I like Zero. I think Zero is one of those companies we feel there's not significant impact in terms of tariff and yeah, U.S. economic slowdown maybe impact. But look, this company majority of the operation is the Australia, New Zealand, and UK, and for U.S. is the future growth. And from everything we know, it's actually doing quite well. And yet it's come off so much. This is one of the companies we bought. We think it looks very attractive.
Okay. BHP. Now, I like BHP because A, the share price is very low compared to where it's been. I like it because I believed you and others that China is on the improve, not going backwards. I also think that China couldn't tolerate the embarrassment of having a bad year while Donald Trump keeps sticking it to them. So, to my way of thinking, BHP looks like a decent buy at these levels. What do you say?
I think so too. I hate to agree everything with you. Look, I think in terms of BHP, share price is very low. At the current iron ore prices, it's still come up great. All that fear about tariff and the like, and you say by the end of the year we won't be worried about it. I think in a month we'll be, not talking about tariff. We'll be talking about back to inflation and interest rate again. So, I think it represents good buying opportunity. And you're very right. China want to see its equity market does well, want to see its economy does well, particularly when US is going through its own challenges. So I think it looks pretty good here.
Yeah, I had dinner with some BHP people a couple of weeks ago, sat beside the chief economist, who's fairly new to the company, but he was very positive about China and how he thought it would help. But he also was positive about India and the fact that BHP sells a lot of thermal coal to India. And that's a story that very seldom gets talked about.
Yeah, look, I think the Indian economy has been on the way up in the last few years, particularly when China gone through its own challenges. And India as an economy has shown its independence in terms of the economic reality is actually quite separated from China in the Asian region. So which has proven to be really good diversification. And for BHP, it's just another market that actually has potential, huge growth potential.
Okay. Sticking with quality companies that have been beaten up recently, I can't help but think that next DC share price just looks too low to be believed. And I think I'm going to have a bit of a punt on next DC, but am I misled?
Oh no, I think at the moment people are a little bit worried about the AI, data center investment and the like. But we've spoken to all the analysts there in the US covering all the tech companies, and all of them have confirmed, all the tech companies, they are not pulling back on AI investment. They are cutting their operating costs, so they're reducing their staff level between 5 and 7%, but they're not cutting AI investment. And everyone's very adamant. So, and then if you're looking at what's been changing in the last little while, how Microsoft talked about pulling back some expenditure, it's actually not. It's just that they're committed to a lot of things. They're just twinkling on around the edges, and those contracts they sort of moved away from. It get absorbed so quickly. So it's massive amount of demand. I think next DC is come upgrade. So they've got this new contract, 150 megawatt contract that's coming. So it's a huge one, and they're just timing. Global volatility maybe pushed out a little bit, a few month here and there, but that one's coming. So you are very right. Other data center exposure like Goodman Group, we also like as well.
Yeah. Well, that's my next one. So
Mm.
I was looking for my five buys, but I got stuck on this one. I thought it's either going to be Goodman Group or Macquarie. Like them both. I like them both.
I,
So I
I
said
think
in
they're
the end, I'll buy both.
I think they're both going higher. I think with the Grumman Group, even if you take out the data center exposure, it's a core business has already returned to what it used to trade at, just for those amazing industrial businesses
Yep.
with the same double-digit growth. And Macquarie itself has been sold off massively. I think really financials is due for a rebound, and then the U.S. banks is really due for a rebound. We saw J.P. Morgan result yesterday, and tonight we'll hear from Goldman Sachs. I think the result won't be as bad as people expect.
Yeah. Okay. That's me. What do
Yeah.
you got? What are you
Oh, I
buying?
got plenty. Oh, look, I got
I
plenty.
got
Probably
plenty.
what you mentioned, I bought all of them. So things like Prometheus, I think it's come off a lot. Great opportunity. I think Life 360 looks great. But look, there's all these companies, the earnings are impacted by the tariff. This is the time to pull the trigger.
Yeah. And I guess there's some of the sell-off was fears around, oh, this is going to create a global recession. Therefore, let's just throw out growth stocks. Let's buy defensive. I think that's going to unwind, isn't it?
I think this absolutely will unwind. If you listen to any of the stockbrokers talking about the stocks to buy, the defensive stock to buy, it's always the same list of stocks. And the risk is that these companies' share price have gone up when everything else has gone down significantly. So the risk is when the market stabilizes, people will sell those companies and buy everything else, which have gone down a lot. So, these share prices will fall. They're not defensive.
Great stuff. Jimbo Liu, thanks for joining us. See you in a couple of weeks' time.
Thank you very much for having me.
And that was Jimbo Liu of 10 Cap. Now, for Paul Rickard of the Switzer Report, we'll ask him what he's seeing right now and what he thinks looks like pretty good value, given the fact that Trump's sell-off has been pretty drastic. Well, Paul, I asked Jimbo Liu if she thought the worst of this Trump sell-off was behind us. I emphasise the worst, like the biggest drop. Do you think it is?
I think we've seen a bit more conciliatory tone over the last couple of days, and markets have scared them. And so, look, I think probably the biggest move downs are off. I'm not saying the market's not going to go back towards some of its lows, but I think you're right. I think markets don't like, you can't have periods of the volatility we've got, right? He reacted to it. The bond market said, and others said, look, this is crazy. Yeah. And now you've got a few things happening, and you've got still contradictory statements, but clearly they're going to work a little bit with the different countries and probably do some of the homework they should have done in advance.
Yeah.
And make sure it works the best for them, and perhaps doesn't necessarily give any too many pains to the American consumer.
Yeah. What about this suggestion over the weekend that iPhones, Apple, electronic products and that sort of stuff that are made in China, but clearly are owned by American companies, that they won't be affected by the tariff? Is that likely to be seen for the market? Because
I think the market's taking what happened over the weekend as a net positive.
Yeah.
Despite some confusing noise from the Commerce Secretary about whether they'd find other ways to tax them. But that's a sign of the White House now realizing that it's a little more complicated. It doesn't want to. The last thing it wants to do also is get the American consumer offside, because it needs the consumer for growth, for company profits, and just to keep faith with the voting electorate.
And that Michigan University survey was down a lot more than was expected.
Yeah, consumer confidence has plummeted. So he's got to keep faith. Yeah, politically, he's got to keep faith with the base. He's got to keep faith with the consumer. Yeah. He needs Wall Street to be on side as much as it can be. Yeah. Sure, there can be a bit of pain. That's okay, but you can't have that sort of volatility. And the last thing also, the reason why the bond market's important is you've got to remember that America is a huge debtor nation.
Borrower.
And it keeps on having to borrow. So if bonds go up, and the US Treasuries is the benchmark that every single loan price is off. If yields on that goes up, it means that corporates pay higher interest costs. Mortgages in the US are also set off the Treasury bond, unlike they are in Australia. It's quite unique, but Americans typically reprice off the Treasury bond. So it meant automatically mortgages got more expensive for people taking out mortgages. Yeah. So that's why he's got to keep them on side a little bit too. So I think, coming back to your opening question, is the worst behind us? Probably. Could there still be some more crazy things? Is the market perhaps now going to worry about what the impact's going to be? Yeah. I think we're going to be a bit more navel gazing, but not necessarily reacting up 10%, down 5%.
Yeah. The best bit, I think, Paul, is that every decision he comes up with now, his team would have to ask, how is the bond market going to react? And if it's a bad reaction like we saw last week, that's going to make them not want to do it. Yeah, that's for sure. All right, so that's it. What have you found to be good buys as a consequence of this sell-off?
Yeah, I still think the ones that we've talked about for the last couple of weeks are probably on the buy side. So Macquarie at the right price, Goodman Group, although you've got to be a little worried about bond rates, but Goodman Group, stocks like Pro Medica, stocks like Xero, uh, things like Car Group, they're all, I think, in the good buy area.
Yeah.
It's interesting that the market has sort of bought them, but the instos are still happy to stick it back at the Commonwealth Bank and Telstra and some of the states.
What's going on there, Paul?
I think that they're just probably a bit like a lot of us, Peter. They don't know what to do, right?
Yeah.
And it's sometimes it's just safety is the best way to play it. So I think they're.
But on the same point, if, for example, a super fund decides to buy CBA now, and the analysts are right that the share price could fall by 30%, which I think is excessive, but a 10 or 15% fall, well, then that's not really a really clever buy, is it?
No, it's not a very clever buy, and I don't. To all honesty, Pete, we want to be careful about who we pick on, but I don't think they're that bright either. So, but they have a much more difficult job than us because. Whereas potentially, if we don't like something or don't like the market, we can all go to cash and get quite a good rate of return for sticking the money in a cash management account. Institutions can't do that. Fund managers can't do that.
Because it's like, for example, the fund manager at Australian Super, he's got a lot of money, if he does decide to sell CBA, he's going to kill the share price of a stock he's holding.
That's right.
It's a bit of a conundrum, isn't it?
And where does he put the money? So it's sort of. It's much
in the CBA term deposit,
and he won't get that. He'll get 0% because the bank doesn't want it, right?
That's right.
So it is a much a lot more pressures on what they have to do to sell something. You got to think what they're going to buy and vice versa. But if you look back even the last couple of months, you look at the performance of some of the company shares. CBA shares are as high now as they were almost on February the 15th. Rest of the market's down 10%. In some cases, the other banks are down 10%, but CBA's hardly moved. So. I just don't think that's the buy zone, but I think the stocks that we've been talking about are the ones to look at. I think there's also like some of the beaten up companies, Cochlear, there's a few other companies out there that are looking more interesting. CSL, probably, but I think we've got to get the clarity about.
Will Trump them?
Will Trump them? Yeah. Could be good buying, so that's probably one to stick away. I don't think CBA, I don't think the banks generally. JB Hi-Fi stays way up there. It's a great company, but it's just not for me. Wesfarmers, great company, but not for me at this sort of price. The resource companies, I think, are the difficult ones because we still don't really know how this is going to play out with China, right? No. And so while BHP's had a good jump today, it's still, if you look at that graph, Pete, it still seems to be trending down. As much as I'm a BHP fan, commodity prices aren't making new highs yet.
Yeah, it seems to me, it's around $36 at the moment, isn't it? If it can go to 40 over the next year, that'd be a nice ride. Even though the analysts think it'd be more than that, but if I can make $4 on 36. That's 1/9. You're the
that's not a bad return.
Not a bad return for you, and plus dividends on top. So, all right. So, what should people be worried about?
Well, I guess it's one word is TRUMP. But look, I think two things. Okay, so watch what Trump is doing. Watch the bond market. And the US bond market, it's found a bit of a level at 4.5%. We went from 4 to 4.5% in the space of about a week, roughly. The bond market loses faith, then eventually the equities market and other markets will crack with it. So if you walk in one morning and the bond market's gone up 20 basis points and the equities market hasn't done much, you should be worried, right?
Yeah, okay. One last question is, despite all this, your best guess, do stocks rise later this year, presuming that some kind of deal will be done with China?
Yeah, I think that's the most likely outcome still. You would expect that it's not in anyone's interest, so you expect logic and common sense to prevail in due course. And you got to, Trump still has a pro-business, pro-deregulatory agenda, which should be good for companies. So
hopefully lower rates.
Hopefully lower rates. So hopefully some of the chaos can go and, becomes a little more measured and well planned, well structured, and companies can, you can sort of declare a bit of a victory. with this base, the markets should be able to get through that. But you know, it's still pretty chaotic.
Yeah. If Trump is able to secure reasonable trade deals, the market will love the eradication of uncertainty, won't they? And that's will be, and that will also help probably lower interest rates as well. So keep our fingers crossed. Let's hope it works out the best possible scenario, Paul. Paul Rickard of the Switzer Report. And that was Paul Rickard of the Switzer Report. And coming up now is David Bates of DHB Consulting. And I'm interested to work out the implications of Labor's idea to ban non-competing clauses. Yep. Thanks for joining us, David.
Great to be here.
Now, I'm really interested in this proposal of Labor to ban non-competing clauses, and pick me up if ever I'm wrong in what I'm saying. It looks like it's proposed to start in 2027. That's what I've picked up. Mm-hmm. Can you explain to us what you've interpreted from Labor's platform?
So effectively, this is an announcement that was made during the budget. So it predates the federal election campaign, but obviously something they're taking to the campaign as part of their platform. And effectively, what they're proposing is to abolish these non-compete clauses for people who are earning below what's called the high income threshold, which is a figure that's set by the Fair Work Commission each year. And right now it's $175,000 per year. So these non-compete clauses usually are framed by way of a restriction on a geographical area, and they're normally time-bound. So for example, in a contract of employment, it might say you can't go and work for a competitor, or you can't compete against us for a period of X number of months or years in some cases, and in the following geographical range. And those clauses, I have to say, are quite often difficult to enforce, but nonetheless, they serve an important purpose of protecting the original employer's business, because they might have built up a strong relationship with clients, etc., and they want to make sure that that's protected as their employees come and go from time to time.
Yeah. So given the threshold was around 175,000. It means that a lot of big businesses won't be worried about losing critically important employees. Won't be prevented from coming after them if they break their non-compete clause. But let's look at the kinds of people that could leave the employers a little bit vulnerable. 175,000, I think, would mean lots of mortgage brokers, financial planners, real estate agents, public relations people, or lawyers. Lots of these people could actually be under 175,000 and be able to, now here's the question, will they be able to take with them their database, their telephone numbers of clients, the emails they've had from them? Would they be able to, in the real world, be able to take those sort of things with them?
Look, a couple of points to make there about what you just said. The first one is to keep in mind that although businesses that are paying people more than 175,000 per year might not be concerned right now, in the papers that the government put forward at the budget, what they made clear was that they were going to further consult about potentially expanding this exemption or prohibition of non-compete clauses. So it might not bite every business right now, but certainly down the track, higher income earners might also be exempted from these provisions. So there is something to be concerned about in the future. Second point is that there are also a whole range of other professions beyond those that you've just mentioned, which might not immediately spring to mind. But for example, hairdressers. And that's one of the particular professions or occupations that the government mentions in its budget papers, because people form a relationship with these service providers in their communities. And when those service providers move on, quite often their clients look to move on with them. So it's a huge range of businesses that are potentially affected by this change. And then third point, to go directly to the question that you just asked, there are other protections that a business has beyond a non-compete clause. So for example, there are clauses in almost every contract around the use and maintaining of confidential information. and intellectual property as well, for that matter. And those provisions are not affected by this proposed change to non-compete clauses. So businesses can still enforce restrictions around the use of confidential information that an employee has had access to during the course of their employment, or indeed things like client lists, etc., and also any intellectual property. But whether or not that's enough to protect a business when the business can't then also rely on the non-compete clause itself, that's a whole other question. And I really think it opens a very, very serious range of concerns for businesses right now.
Yeah, because I guess if someone leaves a place of employ, it's wouldn't be easy to prove that they've taken, say, for example, the phone numbers of the best clients who really love them, and they could just ring up and say, as a courtesy, let's let you know I'm leaving, and I will be starting my own business. And as long as you don't actually say, I want you to come with me, they sort of leave the door open on the possibility of them leaving, and that could really threaten some existing businesses.
That's right. And I think it's, again, important to draw a distinction between a non-compete clause and a non-solicitation clause. So the non-solicitation clause is usually the type of clause that will protect a business from having an employee leave and then go out of their way to make contact with their former clients and try and, poach them and bring them across to them. So again, at the moment, the government's only talking about doing something about non-compete clauses. They're not referring to non-solicitation. However, again, they've said that going forward, that is something that they're open to having further consultation around. So I think what we're seeing right now is just the thin edge of the wedge. Yeah. And once this prohibition on the non-solicitation clause, the non-compete clause takes effect, all of these other parts, non-solicitation, intellectual property, I think there's a real risk that those things will also start to be contemplated in the future as well.
Yeah, I know the government couched all this in the idea of let's get more productivity, and sure, a person who's self-employed often is a little bit more motivated than an employee. Not always, but I think when your money's on the line, you actually do work very hard. So maybe there's a bit of method in their madness, but I also suspect in the digital economy, there's probably a lot of employees who do go off and want to start their own business, and they could be potentially unbelievably productive if they set up their own business. And I think some of those people would be very happy about this. But are you concerned that a lot of small businesses will be threatened by this legislation if it eventually gets up and becomes law?
100%. I'm very concerned by it. And there is something deeply ironic about a Labor government putting forward this proposal. To use their words, this really struck me. They refer to the current use of these non-compete clauses as being a barrier to, quote, pursuing entrepreneurial ambition. Well, I'm all about that entrepreneurial ambition, right? I think it's great. But I've never seen this government promote entrepreneurial ambition in any other way, shape, or form. Whatever they normally are taxing it. They're normally doing something which puts a dampener on entrepreneurial ambition. And yet here we are with this sort of strange proposal out there, which they say is going to sort of open the doorway to all of these people becoming so much more mobile and earning more money, etc. I don't buy it. I don't think that that's really the motivation. And I think small to medium-sized businesses right now are the ones who should be worried, and larger businesses should be concerned about what's going to happen down the track.
Yeah. Do you think, and this is not really your expertise, but do you think at this point in time, lots of the SME, the small and medium-sized sector, aren't aware of this proposal, but it could be something that becomes quite scary if it gets up?
I guarantee you they're not aware of it. I think if we were to go and door knock, 100 small to medium-sized businesses who have these types of clauses in their contracts right now, and were to ask them if they were aware that the government has this proposal and that it was put forward pre-election at the budget, I think I'd be surprised if 5 out of 100 had a clue that this was happening. So I think it's going to take a lot of them by surprise after the election if this then starts to work its way through Parliament.
Yeah, I guess the fact that you mentioned that hairdressers are a case in point. I guess bakeries. There's so many relationships. Like coffee shops in the relationship with the barista. If that barista opens up a shop down the road, guess where the coffee drinkers will go? It's a very, very potentially scary piece of legislation.
Yeah, and that's why I really don't think enough thought's been given to it. I know that the government wants to rely on evidence it says shows that these types of clauses are holding back workers and therefore putting downward pressure on wages. I just don't think that they've really properly considered the ramifications of what this would mean, particularly for small to medium-sized business employers.
Yeah. And at this point in time, if you find an employee has left and you find you're losing customers and you suspect they may well have taken the database with them, how easy is it to prove that that's the case? And then if you do prove it's the case, how expensive is it, to go to court to try and get compensation?
So firstly, not easy to prove. And secondly, very expensive to take it to litigation. And I think the starting point to remember is firstly, there has to be a relevant clause or provision in the contract that you're wanting to rely on. In the absence of an express clause or provision, you're going to have a much, much harder time. But let's presume that there is a clause in the contract, which was a non-solicitation clause, or if you want to use the specific example that we're discussing here, the non-compete clause. Let's assume that that's there. The first thing that the employer is going to want to do is to get an injunction. They're going to go to court first and try and make sure that the conduct stops. Then once they get beyond that initial injunction, they're going to have to try and prove what their damages are. And those damages are going to be very difficult to quantify. You're going to have to be basically calling clients that have left and gone over to the other business, or clients who can confirm that they received a call, whether if it's a non-solicitation type situation. So it is a difficult exercise, and it is unbelievably expensive because you're going to have to take action almost immediately. If you sit on your hands, the courts basically look at that and say, well, why did you delay? If this was such a risk to your business, you needed to act quickly. So people do act quickly, but that's expensive.
Yeah. And the answer to the judge would be, well, it was too expensive for me. And I just hope it wasn't as bad as it turned out to be. But hey, that's just me who owns a business. David, thanks for joining us.
Thanks.
And that was David Bates of DHB Consulting. If you have any questions for us or you'd like to know more about the Switzer Report, go to switzerreport.com.au. That's our show for this week. I'll see you next week.